Hello, friends. In 2026, if you were born before 1968 and you have money in a savings account, a CD, or a money market account, the interest on that money can do more than add a line to your tax return. It can make part of your Social Security taxable. It can raise your Medicare premium. And for a married couple where both spouses are on Medicare, the first surcharge tier alone adds up to $22,968 over 10 years. Your bank reports that interest automatically. Nobody explains the chain reaction automatically. Nearly 5.8 million older adults who qualify for help programs right now are not getting them because no one told them. Today, I am walking you through 6 places that interest can hit and what to do about every one of them. Hello, friends. This is not a video about hiding income from the IRS. It is not a video about doing anything clever or anything risky. It is about understanding the exact places where one line of bank interest can hit you. Places no one explains when the interest starts showing up. Grab a pen and something to write on. I am covering 6 items today. Mark the ones that apply to you because at least one of these 6 is yours if you receive Social Security, Medicare, or both. These thresholds change every year. The premiums change. The income limits for help programs change. And no agency sends you a clean explanation when they do. The people subscribed here find out in time. Subscribe now and let's get into it. Before we go any further, I need to address something, because people hear a topic like this and sort themselves into one of 2 groups in the first minute. The first group is the comfortable retiree, some savings, maybe a CD ladder, a decent pension, and they figure this is aimed at people in worse financial shape. The second group is the fixed income retiree who counts every dollar and has learned to assume the helpful programs are always meant for someone else. Both of those assumptions are wrong about at least one item I am covering today. And on every single one, I will tell you exactly which group it helps most. Now here's what I need you to stay for. The first 5 items are about what this interest can cost you. The 6th item, the last one, is the part most people never hear. Not the tax, not the penalty, the legal ways to stop future interest from landing in the worst possible place. Stay with me to the end for that one. Number 1, the form that starts the chain reaction. Here is the misconception. People think if the bank only paid a small amount of interest, it probably does not matter. That is wrong. If your bank credited you $10 or more in interest during the year, they are required to send the IRS a form called 1099-INT. And here is the part most people miss. Even if your interest was under $10 and no form was sent, you are still required to report that interest on your tax return. The IRS sees the form before you do. The reporting is automatic for the bank. Understanding what it triggers is on you. Let me put a number on this. Say you have $40,000 sitting in a high-yield savings account paying 4.5%. That is $1,800 a year. That is $150 a month showing up on a line the IRS can see. And once your total taxable interest crosses $1,500 for the year, the IRS requires you to fill out Schedule B on your return. That is not a penalty. It is an extra form, and it puts your interest income in a place where everything else in this script starts to matter. This one helps both groups, the comfortable retiree and the fixed income retiree. Anyone earning taxable bank interest needs to understand this reporting rule. Here is your action step. Pull every year-end 1099-INT. Check whether your total taxable interest is over $1,500, and ask your bank this exact question. I need the exact amount of interest credited to this account for tax year 2026 and the exact date it was credited. That date matters. You will see why. That is number 1. That is the reporting rule. Now let me show you the mistake people make the minute they hear the word bracket. Number 2. Why a higher bracket is usually not the scary part. The misconception here is one of the most expensive misunderstandings in personal finance. People hear that extra interest pushed them into a higher tax bracket, and they think all of their income is now taxed at the higher rate. That is not how it works. Only the dollars above the cutoff are taxed at the new rate. Everything underneath stays exactly where it was. For 2026, the standard deduction is $16,100 if you file single, and $32,200 if you file married jointly. After that deduction, the first $12,400 of taxable income for a single filer is taxed at 10%. From there, up to $50,400, the rate is 12%. Above that, up to $105,700, it is 22%. Married filing jointly, those brackets are roughly doubled. So what does $1,800 of extra interest actually cost you in a 12% bracket? about $216 of extra federal tax. That is $18 a month. At a 22% bracket, it is $396 a year, $33 a month. Over 10 years, we are talking $2,160 to $3,960, depending on your bracket. Real money, but probably smaller than the fear suggested. This one helps the comfortable retiree most because they are the ones most likely to worry about bracket creep and overestimate the damage. Your action step: compare your expected 2026 taxable income to the actual bracket cutoffs I just read. Use the IRS 2026 inflation adjustment page on irs.gov. Do not guess your bracket. Look it up. That is number 2. And that still is not the expensive part. The next line is where a little bank interest can start pulling your Social Security onto the tax return. Number 3. The Social Security tax line most people never calculate. Here is the misconception. People assume their Social Security is either taxable or it is not, and that bank interest does not change the answer. That is wrong, because the formula the IRS uses counts something called combined income, and bank interest is part of it. So is tax-exempt interest. So is half of your Social Security benefit. The formula works like this. Take your adjusted gross income, add any tax-exempt interest, add 1/2 of your annual Social Security benefit. That total is your combined income. If it is above $25,000 as an individual, or $32,000 married filing jointly, up to 50% of your Social Security can become taxable. If it is above $34,000 individual, or $44,000 joint, up to 85% can become taxable. Let me show you how fast this moves. A woman I heard from in Ohio, a retired school secretary named Helen, 72, outside Columbus, had about $20,000 a year in Social Security and $15,000 from a small pension. Before the interest, her combined income was $15,000 plus half of $20,000, which is $25,000. Right at the line. Then a high-yield savings account added $1,800 of interest. Her combined income became $26,800. That $1,800 did not stay $1,800. It made $900 of her Social Security taxable. The total extra income in play was $2,700. At a 12% rate, that is about $324 of extra federal tax, from interest she thought was just sitting there quietly. She had done everything right except one thing. She never ran the combined income formula. This helps both groups. The thresholds hit fixed-income households and middle-income retirees alike. Those base amounts have not been adjusted for inflation. They are the same lines Congress set decades ago. Your action step: run combined income on paper. AGI plus tax-exempt interest plus half of Social Security. Compare it to $25,000 single or $32,000 joint. You can find the full worksheet at ssa.gov or in IRS Publication 554. And say this to yourself or your preparer. I want to know whether my bank interest is pushing my combined income over the Social Security tax line. That is number 3. Now, if you thought this was only about April 15th, read this next part carefully because now we are talking about Medicare. Number 4. The Medicare surcharge that surprises the comfortable household. Everything I have covered so far shows up on your tax return. This next one shows up on your Medicare bill. I need you to hear this one carefully. There is something called IRMAA, Income-Related Monthly Adjustment Amount. In plain English, it is a surcharge Medicare adds on top of your standard Part B and Part D premiums if your income was above a certain line on a prior tax return. And the standard Part B premium for 2026 is $202.90 a month. That is the baseline before any surcharge. Here is what catches people. The first IRMAA tier for 2026 kicks in above $109,000 for a single filer or $218,000 for married filing jointly. And IRMAA does not use just your wages or your pension. It uses something called modified adjusted gross income, which includes tax-exempt interest. And here is the part that surprises the most people. 2026 IRMAA generally uses your 2024 tax return. A CD that matured 2 years ago can be raising your Medicare premium right now. The first tier surcharge is $81.20 a month added to Part B and $14.50 a month added to Part D. For one person, that is $95.70 a month, $1,148.40 a year. For a married couple where both people are on Medicare, double it. That is $2,296.80 a year. Over 10 years, that is $22,968. Someone in the comments once asked me why a bank CD suddenly changed what Medicare charged them. A couple outside Tampa, James, 69, a retired machinist, and Carol, 67, a retired bookkeeper, had joint income sitting just under the 2026 IRMAA line. A December CD maturity added interest to the return Medicare later used. That one deposit pushed them into the first surcharge tier. The fix was not complicated, but it required knowing what to look for. They started checking maturity dates and crediting dates instead of chasing only the posted rate. And if a true qualifying life-changing event happens, a work stoppage, a retirement, a death of a spouse, the correct form is SSA 44. Not a phone complaint, a specific form. This one helps the comfortable household most. This is where the viewer who assumed this whole video was for people in worse shape gets surprised. IRMAA does not care how reasonable the interest felt when you earned it. Your action step. Check the tax return Medicare is currently using for your premiums and compare it against the 2026 IRMAA lines. If you had a qualifying life-changing event, file Form SSA 44. Call 1-800-772-1213 and use these exact words. I want to request a new initial determination for my IRMAA because I had a life-changing event. You have 60 days from your IRMAA determination notice to request reconsideration. That is number 4. That is the hit that catches the comfortable retiree off guard. The next one is where the fixed income household can get hurt faster. Number 5. The benefit cliffs, where a little interest can cost a lot. The misconception here is simple and expensive. People think a small amount of bank interest cannot possibly matter for help programs. But when a program has a hard income screen, $150 a month of interest is not small. It is the difference between qualifying and not qualifying. Let me walk you through the real numbers. There is a program called QMB, Qualified Medicare Beneficiary. What it does is pay your Part B premium for you. It can also cover Medicare deductibles, coinsurance, and copayments. The 2026 monthly income limit for QMB is $1,350 for an individual and $1,824 for a married couple. The resource limit is $9,950 single, $14,910 married. Then there is SLMB, Specified Low-Income Medicare Beneficiary. It pays your Part B premium. The 2026 income limit is $1,616 single, $2,184 married. And QI, Qualifying Individual, also pays the Part B premium, with a limit of $1,816 single and $2,455 married. QI must be reapplied for every single year, and funding is limited. Priority goes to people who had it the year before. There is also Extra Help, the program that helps cover Part D prescription drug costs. The 2026 income limit is $23,940 for an individual and $32,460 for a married couple. The resource limit is $18,090 individual, $36,100 married. Now picture a widow living on $1,300 a month of Social Security. She qualifies for QMB. That program is paying her Part B premium of $202.90 every single month. Then a CD she forgot about matures and adds enough interest to push her monthly income above $1,350. She loses QMB. That is $202.90 a month back on her shoulders. That is $2,434.80 a year. Over 10 years, that is $24,348. Before you even count the copays and deductibles QMB was also covering. And here is the number that should stop you. According to the National Council on Aging, nearly 5.8 million eligible older adults are not enrolled in Medicare Savings Programs. Only about 46% of people who qualify are actually getting the help. Not because they were denied, because nobody told them it existed. None of this is automatic. Nobody screens you. Nobody calls. The help sits there until you ask for it by name. This one helps the fixed income household most. This is where a seemingly modest interest amount matters more than anywhere else in this script, because the loss is not just a tax line, it is premium assistance, drug cost help, and program eligibility disappearing at once. And it does not stop at Medicare. SNAP benefits, food assistance, have income screens too. For a one-person household in 2026, the federal gross income limit is $1,696 a month. LIHEAP, the program that helps with heating and cooling bills, varies by state. If you need the LIHEAP hotline, it is 1-866-746-327. But every state sets its own income rules, so check your specific state's program. Your action step: call 1-800-MEDICARE, that is 1-800-633-4227, and ask to be connected to your state Medicaid office. Then say this: I want to be screened for every Medicare Savings Program and extra help, and I want the 2026 income and resource limits explained to me. Ask how interest income is counted in your state's application. Do not ask for just one program by name, ask for all of them. And remember, I must be reapplied for every year. That is number 5. And now for the part that gives you some control back: 4 legal ways to change where or when this interest shows up. Number 6. The legal ways to change where or when the interest lands. This is the item I told you to stay for. After 5 items about what savings interest can cost you, this is the one about what you can do about it. And the core idea is simpler than people expect. You may not control whether interest exists, but you often control where it is earned and which tax year it shows up in. The first tool is Series 1 savings bonds, I-bonds. When you buy an I-bond through Treasury Direct, the interest generally is not reported as income until you redeem the bond, dispose of it, or it reaches final maturity. That means the interest grows but does not hit your tax return, your combined income formula, or your IRMAA calculation until you decide to cash it in. The 2026 purchase limit is $10,000 in electronic I-bonds per person per calendar year, plus up to $5,000 in paper I-bonds purchased through your federal tax refund. One thing to know: if you redeem before 5 years, you lose the last 3 months of interest. That is the trade-off. The second tool is a Roth IRA. Qualified Roth distributions are tax-free. They do not show up as taxable income on your return, which means they do not feed into the Social Security combined income formula or into IRMAA-MAGI. The 2026 contribution limit is $7,500 or $8,600 if you are 50 or older. But here is the hedge: Roth contributions require taxable compensation. If you are fully retired with no earned income, new contributions may not be available to you. Check with your tax preparer before assuming this one applies. The third tool is municipal bond interest. It is generally exempt from federal income tax, but, and I need you to hear this clearly, tax-exempt interest still counts in the Social Security combined income formula, and it still counts in the IRMAA-MAGI calculation. So municipal bonds are not a clean escape hatch for those two systems. They help on the regular tax line. They do not help on the benefit lines. The fourth tool is timing. Interest is generally taxable when it is credited to your account or available for you to withdraw without a substantial restriction. If you have a CD maturing in December, the interest credited that month lands on that year's tax return. If the same CD were structured to mature in January, that interest lands on the next year's return instead. You are not erasing $1,800. You are deciding which tax year it lands in and which year Medicare looks at when it sets your premium. Remember Helen from item 3? If she had placed some of that $40,000 into a vehicle where the interest did not hit her return that year, the combined income formula would not have pulled her Social Security into taxation. Remember James and Carol from item 4? If that CD had matured in January instead of December, the interest would have landed on a different return, potentially a return Medicare was not using for that premium year. This helps both groups. Everyone with cash reserves can use some version of these tools. The key is matching the tool to your actual situation. Your action step: ask yourself how much of your cash truly needs same-day liquidity. Then review whether I-bonds, Roth eligibility, municipal bond caveats, or CD crediting dates apply to your situation. Call your bank or CD issuer and ask, on what exact date is the interest credited, and is it available to me without penalty on that date? Then talk to your tax preparer about constructive receipt rules before making any changes. That is number 6. So here's the full picture. The first hit is the reporting rule itself. The bank sends the form whether you were thinking about it or not. Pull your 1099 INTs and know your number. The second is the bracket myth. Usually smaller than the fear, but still real. Look up the actual 2026 cutoffs. The third is the Social Security line, where $1,800 can turn into $2,700 of income in play. Run the combined income formula on paper. The fourth is Medicare IRMAA, the one that surprises the comfortable household. Check which tax return Medicare is using right now. The fifth is the benefit cliff, where a modest interest amount can matter more than anywhere else. Ask to be screened for every program, not just one. The sixth is control, where and when that interest lands next time. Ask your bank the exact crediting date. Now let me say this plainly, because it is the single most important thing in this video. The bank does not explain the tax chain reaction. Social Security does not call when interest makes more of your benefit taxable. Medicare does not waive IRMAA because the interest looked harmless. Your state does not automatically screen you for every savings program, and the right cash location does not choose itself. Being legally required to report the income and being fully informed about what that income can trigger are two different things. The gap between them is information, and that is exactly why this channel exists. Now I want you to think of one person, a parent, a neighbor, a friend from church who finally started earning real interest again after years of near zero rates. Share this with them, not because they are struggling, because the odds are very good they think this is just a little bank interest, when it can touch their taxes, their Medicare premium, and their benefits all at once. Subscribe. Share this with someone you know who has money sitting in a savings account or a CD, and I'll see you in the next one.